Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Parkamonic. How you doing, D?
Good morning, Will. How are you?
You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor. Call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
I'm going to share my screen.
While you're doing that, a housekeeping note. We have a webinar, IBKR webinar, so you have to register on their site. I will put that link. I think we're discussing zero DTE options, correct?
Yep.
Tomorrow, the 11th at 2 p.m. So I'll put that in
the live
chat
and in the email. Yep. So we'll discuss a couple tools that we just recently published, and it's regarding analysis around zero DTE options, 0 days to expiration options, and different ways to analyze those options. So that will be tomorrow, 2 p.m. Eastern. With Interactive Brokers, you do have to register with Interactive Brokers because they will be hosting it.
Perfect.
Yep. And anyone joining us for the first time today, Will and I, we do this show to help answer questions you may have about the Market Chameleon tools, data, or analytics. If you want to come on a show and ask your question live, Will puts out a link to Zoom on that live chat on YouTube. So click on that. When you get to Zoom, click on a button, raise your hand. You could ask your question direct. If you prefer to type your question, you can put your question, type it into the live chat on YouTube. Will's watching that. He'll read them back to me. And while we're waiting for questions to come in and for more people to join us, we'll start out taking a look at the pre-market report. These are stocks trading at pre-market hours. See if we could get some insights. And after a couple minutes, we'll go to the questions. Okay. So pre-market report. These are stocks trading in a pre-market hours. I'm going to scroll down a little bit. Down here, we have 3 different lists of stocks. One is the most active stocks in the pre-market. We have a list of our biggest percentage gainers and biggest percentage decliners. Coming down here, and I see 44 stocks made our percentage gainers list, 27 on our decliners. So from this perspective, looks like we're setting up for a slightly bullish bias at the open. And these lists, they are made up of stocks that have to meet certain thresholds. So we try to get the most relevant ones in there based on volume traded in the morning, percentage move, other thresholds. So let's take a look at what's going on maybe from a top level. So what's going on in the entire market. And I'm going to come up here, and we have this calendar view that you could go back days. This is the most recent day, July 10th. So this is what's going on in a pre-market right now. And we have 444 stocks that are trading higher than the previous day's close in a pre-market, 273 stocks trading lower. If we take a look at the volume, there are about 150 million shares traded in the pre-market so far on up volume versus 68.4 million down volume. And if we convert that volume to dollar value, right? So not each stock price is the same. So if we take the volume converted to actual dollars, there's $1.6 billion worth of stock trading higher versus 1.3 billion lower. So that's a little bit actually more even dollar-wise. Still slightly leaning towards the bullish bias. And it take another minute to come down here, and when we see this list, we get a lot of stocks in there that could be low cap stocks, ETFs, leverage products. And if you want to filter this list down, you can use the filters above to filter it to a smaller group. And as an example, I'll use this filter here in ETF. I'm going to click on it, get a drop-down menu of ETFs to choose from. SPY, that's top one, that's the S&P 500 ETF. So let's click on that. And when you select it, the list below will get filtered by stocks that are holdings in the SPY ETF. So here we see one stock made our percentage gainers list, 5 on our decliners. Again, it has to meet certain thresholds. And from that perspective, we get a little bit of a different story. It looks like we're looking at a slightly bearish bias at the open, right? So now we got like mixed signals here with S&P 500 and then, a view from the top level. So keep that in mind, pretty mixed. It's not strong either way. But that's where we are right now prior to the open. So if we have questions, I'll take some questions. If we don't, I'm going to move on to continue on some conversations we had from last week.
All right, perfect, D.
Okay, no questions?
Nope.
Okay. Let me build on top of last week. We had some
AD?
Yeah.
Sorry about that. Sarush just popped in with a question. He said, good morning. Question. Is there any research thesis book a trader should read? Thank you. I guess he's asking, outside of Market Chameleon, are there any things you do from a research standpoint? Any other books, papers, articles? Where do you?
I mean, there are so many. So it depends on what you're trying to learn and accomplish. There are books on, option prices and volatility, on risk management, on stock valuations, on so many different things. It really depends on what you're trying to learn and what you're trying to do. So, I can't say there's, one particular book that will cover everything, because the field of finance is very large. So if you're looking for something maybe more specific in particular, there might be some good resources out there. But one good resource I would say for options, I think the Options Industry Council could be a good resource. They talk about, I think they give webinars. They talk about different option strategies. Their whole mission is to educate people about options, right? So if you're looking for some resources regarding, learning about options, the Options Industry Council, that's their mission. I think they're funded by the exchanges. Is that correct, Will?
That is correct. Yep.
They're funded by the exchanges, supposedly. I think they're a nonprofit, and their mission is to educate the public how to use options. So maybe that's like a starting point.
Yeah, actually, also I would recommend the IBKR library is huge, and it is also
IBKR,
that's Interactive Brokers. They have a huge library, lots of different. And the OCC actually does webinars with IBKR. So there are lots of different individuals, businesses, traders who are interviewed. So
like that's what we're doing, an Interactive Brokers webinar tomorrow, but they try to educate people using webinars, articles, different types of podcasts. I think a lot of the brokers do as well.
Yeah. Sarush then asked trading purely credit put spreads, and Mike mentioned Nattenberg's book.
Nattenberg is a good one. Nattenberg is a good book if you want to learn about option pricing and volatility. Very good book. So that's one I think we started out Will and I, when we were getting our training, that was the first book that they gave us to read, study. I think they even gave us tests on it. So the Nattenberg book is a good book.
Rob just asked, I know you've shown this before, and he asked, Will, could Dimitri show how we can get to the list that formerly was the landing page? We've obviously changed the landing page so many times. I guess there was something on the landing page, and Rob, maybe you want to expand what you liked. He said it gave a lot of great information for potential trades. I guess a starting point for trades.
So I think that if you're we changed the landing page. Before we had a list of potential credit spreads, because one of the most requested features were to look at put spreads, credit put spreads. So we kind of just started out there. But you could do a couple different things. You could go here to the trade ideas, look for bull put spreads, and just kind of like go through these. You could create your own list, my watch list, recently viewed, or you could look at the most active stocks. So these will be the most active stocks if you're looking for bull put spreads. This is the one way to, bullish opportunities here. So these are stocks that are displaying bullish behavior. So you could just go through them and look for bull put spreads if they have them. These would be the different cards. So that's one quick way. Once the market's open, you get these alerts. You could also just filter it by bull put spreads. So let me see here. Bullish put spreads. Right now, this is set up to work when the market's open. It's not, so there are no alerts. But if you just click on that, you'll get a list. So that's the quickest way to do it from the landing page. You could also go to the screener and set up the screener with bull put spreads. Use your own filters, and just go to the screener, refresh it, save your filters. Save a filtered report, and then you could go back to it, bring up those filters, and see what pops in at that moment or at that time.
Perfect.
Yep. Let me see if there are more questions. Let me know, Will. What I'll do is, in the meantime, let's take a look at these trade ideas, because last week we had some questions about theoretical values. So we have market prices, theoretical values, win rates, and edge. And I wanted to paint you guys a difference between there are different financial models, right? And the models try to answer questions. That's what you're trying to do. Try to answer some kind of question that you may have. And I want to discuss the difference between a valuation model, right? So you have a valuation model. You could also have a forecast model, right? Forecast prediction. We could have a model of probabilities. And I'll stop there. So there are more models, but let's stop there just to discuss the differences, because I think people get these confused or conflate them, but they're telling you something very different. So in a valuation model, some people confuse these, okay? Either confuse these or conflate these, or think that they're all all created with one output, but they're not. Okay, so you would have to separate these, and they tell you something different. So valuation model, it's trying to create a theoretical value of what is something is worth. Okay, so think of it this way: when you buy a house, right, your real estate broker, or when you're selling a house, your real estate broker says, well, this is the market, this is what we think, you should try to sell it, or an appraiser comes and they say, this is what we think the house is worth today, given the inputs, right? So you could do that with a used car. Well, what is a used car worth today, right? So this is trying to create what is a fair value today, reasonable, and it's an estimate, because there's no way you can't get anything down to a penny until it trades, but you're trying to get some reasonable estimate with some standard error of what you think, something is worth based on certain inputs, right? So, when you have an appraiser come, like, what is a house worth? You're going to have an appraiser come out, from the bank, and tell you what they think it's worth. And it could be certain inputs like, square footage, recently sold homes, comps, the age of the house, all this stuff, what does it cost to replace? And you come up with a value, and you want to compare it to the market prices. So that's a valuation model. And it's very important, and you have valuation models almost on everything, on bonds, stocks, options. You could create valuation models on everything. That's what it's trying to tell you. What, like, based on my inputs, what do I think this security is worth? Now, that is different than from a forecast model. Okay, so when we look at, like, here, theoretical value, right? That's not a forecast that's saying theoretically this is what we think the option is worth based on the inputs that we have from the data, historical stock behavior, and what it did during earnings, where the implied. So all these inputs comes up with a theoretical value, and you use it to compare it to the market prices to see how far away did the market prices deviate from some kind of theoretical value benchmark, right? And the market could be telling you something. If it's deviating far away, that could be the market signaling something. It could be just a supply and demand thing, or it could be that there's something else in the market that's making it move in one direction. So a forecasting model would be different. Forecasting model is saying, what do you think will happen in the future, right? What is what will happen in the future, right? That's a forecasting model, and that's different. So what would maybe in here, right? Here you might use a different model with different inputs, like maybe I know that the house is worth today. Let's say you think a fair market price is 100,000. But what do you think 1 year from now? Right? What do you think 1 year from now is worth? So now you're trying to do a forecast going forward in time. And this you could try to model by saying, okay, well, let's stick with the house. You have population growth. You could put in there, income growth. You could try to put in, new home supply. If they build a lot of new homes, that will increase supply. If they can't build any new homes, that will decrease supply. You know, all these inputs you can imagine that you're going to put in there and say, well, these in a year create pressure that it could increase 5%, increase 6%. And this is different because now you're trying to say, irrelevant where the market is, what kind of pressure are we looking at a year from now? And where are we going to be a year from now? And that's a forecasting or prediction model of saying, even if we could achieve the fair price today, so this would be what we think, a fair price would be today. And a forecast model is, where do we think things will be in a year from now? And these are all assumptions. Your models are trying to work with assumptions based on information and data, and they're not perfect, right? You're trying to create some reasonable models, but you would look at these differently. Okay, so these two are different. Then we could have a model probabilities, and these are usually, you could think of as like a logistical regression question. Some models, like, think of if you think of like a credit card company, right? A credit card company wants to know, will this person default? Here's an individual customer. If I put a hit, their income, their age, their, all these inputs, will they default? And usually the model gives you an answer by giving you a probability. There's a 10% chance of default or an 80% chance of default, right? And this is usually, ask question, how likely is something, happening, right? How likely is something, like if a baseball player tries to go and goes up to bat, well, how likely is he's going to hit? We don't know exactly if he's going to hit it or not, or what's going to happen. He could have a good game, he could have a bad game, but what we could do is try to run a statistical model to give us some estimate how likely is he going to hit, and those things change. Those things could error, those things could change and tweak. So all these models are trying to kind of answer different questions, and they're separate. Okay, the models could have different inputs. They could have different assumptions in there. They're different models, right? So the way you generate the models are different, or how they're calculated. And it's important to understand the differences, because if you're mixing them up, right? If you're mixing them up and saying, well, if you're looking at a valuation model and thinking it's a forecast, you're not using it correctly. And the model doesn't know how you're using it, right? So the output is just the output given the data, the inputs, the assumptions, and you get an output, and how you use it, is up to you. The models don't know how you're using it. So when you're looking at a valuation model, it's not a forecast model. This is saying that given all the variables that we put in, given all the assumptions, this is where we think it should be around. Based on that, then we could compare that to the market and say, well, why is it, is it relatively in line, or how far away is it? And why, or do I agree with it or disagree with it? Okay. Forecasting model, completely different. That's trying to say, where do I think, if interest rates are moving higher, if, unemployment is moving higher, if this is this, and there's a lag in this, where do I think we're going to be a year from today? So irrelevant where we are now, where do I think we're going to be a year from today? And that's kind of like what the Federal Reserve is doing, right? The Federal Reserve is trying to forecast the economy into the future and how will its policies impact it with a lag. All right. So they're trying to slow down the inflation. All right. And they think that the tools that they're using, they're forecasting, will slow down the inflation eventually to get to their target price. They're using forecasting models. Right. It's not a valuation model, it's a forecast model saying, if we do this, then in the future, this is what we think will happen. All right. So look, those are big differences. It's important to understand them and not to conflate them and separate what this is trying to answer, what that's trying to answer, and what the other one's trying to answer. Okay. So that's pretty much, we're almost at 9:30. Will, maybe I'll stop there. Unless you have a question. Well, I think you're on mute still.
Yeah, sorry about that. I was sneezing.
Okay.
No, it's perfect.
Okay.
No follow-up questions. Remember, everyone, to register for the webinar that will be happening on Tuesday, which is tomorrow at 2 p.m. Hit that link, register. I know a few of you registered at the beginning, so thanks. Great job, Demon, as always.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
All right.